One of the best performing stocks in America right now belongs to a chain of pawn shops. Not a tech company, not an AI lab, a pawn shop chain. Sit with how strange that is, because that's really the whole story. Picture a guy named Jacob sliding a $3,000 Snap-on tool set across a pawn counter in suburban Detroit. He's an HVAC technician making $80,000 a year. By every official measure, he's doing fine. And he's pawning the tools he uses to earn a living just to make it a Friday. Here's the part that should bother you. The company that just took Jacob's tools has seen its stock roughly double over the past year, while the S&P 500 returned a fraction of that. Same economy, one man pawning his livelihood, one stock chart going vertical because of people like him. Take him. And today we're digging into why both of these things are true at the same time and which one actually matters. Let's start with what Jacob did, because most people misunderstand the mechanics. He didn't sell his tools. A pawn loan isn't a sale, it's a loan, and the tools are collateral. He hands them over, the shop hands him cash, and he has a window to repay the loan plus fees and get his tools back. If he misses that window, the shop keeps the tools and sells them. Here's where it gets less simple. Say you borrow $500 against a wedding ring and hold that loan for 90 days. You'll pay roughly $300 in fees and interest to get it back. $300 on a $500 loan over 3 months. Run that same $500 through a credit card for 90 days, and it costs about $30. So a pawn loan can be roughly 10 times more expensive than the credit card everyone warns you about. Effective annual rates in this industry range from around 60% to over 200%, depending on the state. Suddenly your credit card looks like a charity. So why would anyone do this? Because there's no credit check, no application, no waiting. You walk in with an object and walk out with cash. Nobody calls your employer or checks your credit score. For someone who needs $400 by Friday or the lights go off, a pawn shop isn't the worst option. It's often the only one. And here's the part that reframes everything. Most of these loans actually get repaid. Industry redemption rates run around 80 to 90%. People do come back for their belongings. Jacob almost certainly plans to reclaim his tools. But the fees never come back. They're gone the moment the deal is done. So you have millions of people borrowing small amounts, paying enormous rates, getting their items back, and doing it all again the next month. For a lot of people, this isn't a one-time emergency anymore. It's become routine financial plumbing. Keep that word, plumbing, in mind, because that's exactly what Wall Street figured out, and it's why pawn shop stocks are among the best performers in the country. The two major public pawn companies are First Cash and S-Corp. In early 2026, First Cash generated over $1 billion in quarterly revenue, up 26% year over year. Their outstanding pawn loans hit a record $851 million, all lent out against people's personal belongings. Their stock roughly doubled over the past year, while the S&P 500 gained only a sliver of that. The most boring business in America, lending against power tools and wedding rings, outperformed the entire tech-driven stock market. S-Corp told a similar story, with revenue up 46%. Here's a detail that does a lot of quiet work. The average pawn loan size jumped from around $160 a few years ago to about $240 now, a 50% increase. Desperation, it seems, is keeping pace with inflation, which is more than can be said for wages. So why is the market in love with this? Because investors aren't betting on reselling old guitars, they're betting on the IOUs. The fastest growing part of these companies is the loan book itself, the debt secured against household belongings. When Wall Street pays a premium for a lender, it's making one specific bet, that the loan book keeps growing. Read that again slowly. The market is pricing in more pawn loans next year than this year. That's not a bet on the economy improving. That's a bet on the squeeze continuing. Let's give this phenomenon a name, because once you have a word for it, you'll start seeing it everywhere. Call it the desperation spread, the gap between the stock market hitting record highs and the lender of last resort posting record loan volumes. Right now, the smartest money in the world owns both sides of that spread. Here's the part that turns this from a finance story into a gut punch. the same asset managers running your retirement accounts hold massive stakes in these pawn companies. Vanguard alone owns around 9% of First Cash, roughly $900 million. So the firm managing your 401k collects a cut every time someone like Jacob rents back his own tools at 200% interest. Your retirement and his rock bottom are sitting in the same fund. So who's actually walking through these doors? If your mental image of a pawn shop customer is someone in a back alley, that picture is about 40 years out of date. Operators say the customer base has gone suburban and gone upmarket. It's small business owners coming in with Rolexes. It's tradespeople with $2,000 to $3,000 tool sets, like Jacob. It's women pawning inherited jewelry. A significant chunk of new growth comes from households earning $60,000 to $100,000 a year. People with jobs, retirement accounts, people who on paper are solidly middle class. The pawn counter stopped being where you go when you're poor. It became where you go when you're employed and still can't make the timing work. A Detroit pawn broker named Michael Goldstein, who's been in the business for 40 years, said something that could be the thesis of this entire piece. You can see how the economy is doing by watching what happens in a store, sometimes before Wall Street does. He calls his shop the canary in the coal mine. When gas prices rise and unemployment ticks up, he sees his customers hurting months before it shows up in headlines. Now layer one more thing on top, because it explains why this is spreading into neighborhoods it never used to touch. America is quietly losing its bank branches. The country went from around 86,000 branches in 2017 to roughly 73,000 at the start of this year. Over 900 closed in a single year, with closures hitting lower income and working class areas hardest. So picture the timeline. A bank closes and leaves a strip mall, and a lender charging 200% moves in a few doors down. One kind of credit gets pulled out of a neighborhood at almost the exact moment a far more expensive kind moves in. It's not a conspiracy. It's just what fills a vacuum. That's the ground floor. Now let's take the elevator up to the penthouse, because the view from up there couldn't be more different. The stock market in early 2026 isn't just high. It's historically eye-wateringly high. The Shiller-Cape ratio, which smooths earnings over 10 years to gauge valuation, is sitting near 43. The only time in 145 years it's been meaningfully higher was December 1999, 3 months before the dot-com bubble burst, and the Nasdaq lost nearly 80% of its value. So we're sitting in the second most expensive market in U.S. history, looking in the rearview mirror at the most expensive one. And households are all in. Americans now hold a record share of their financial assets in stocks, higher than the dot-com peak, higher than 2007. Everyone's in the pool, and the pool has never been more crowded or more expensive to swim in. Normally, this is where someone reassures you that if things wobble, the Fed swoops in, cuts rates, and catches everyone. That's the reflex we've all been trained on. Except this time, the Fed mostly can't. Inflation flared back up due to energy prices, so instead of cutting, they're sitting on their hands. At their last meeting, officials disagreed with each other more than at any point in over 30 years. On top of that, most people with mortgages already locked in rates below 6%, so even a rate cut wouldn't reach them. The fire escape everyone's quietly counting on is welded shut. Hold on to that. It matters more at the end of this than it does right now. Here's the line that ties it all together. In 2025, the top 20% of earners spent more than ever, while the bottom 80% spent less, and their spending hasn't kept pace with inflation for 6 years. 6 years. So when you hear the consumer is strong, understand what that really means. One consumer is strong. The one whose portfolio just doubled is out there spending, and that spending is so large it papers over everyone else quietly drowning beneath it. This is the K-shaped economy, and the K is the whole story. One arm goes up, the other goes down, and they start from the same point. From a distance, on the aggregate chart, it averages out to a flat, healthy-looking line. Up close, it's two completely different countries that happen to share a currency. And the distress isn't just a vibe, it's in the numbers. The personal savings rate fell to 3.6%, the lowest in years, meaning whatever financial cushion people had has basically evaporated. Subprime auto loan delinquencies have pushed past 2008 financial crisis levels. Sit with that. People are falling behind on car payments at a worse rate than during the Great Recession, while the market sets records. Then there's the statistic that genuinely stops me. A record number of people are taking early hardship withdrawals from their 401k. Yes, cracking. Open retirement accounts, eating the taxes and penalties to cover an emergency right now. The top reasons cited were avoiding eviction and covering medical bills. That's the financial equivalent of burning your furniture to heat your house. And it's happening at the very same time the stock market inside those same accounts is hitting all-time highs. People are setting fire to their future to survive their present. And the fire is fueled by the very thing that's supposedly booming. Want the same story without the pawn shop? Go to a dollar store. On their most recent earnings call, Dollar General CEO said the biggest jump in new customers came from households earning over $100,000 a year. He even named the trigger. When gas hits $4 and stays there, the trade down begins, and their core customer needs them most. It's the same paycheck timing squeeze the pawnbrokers described, just one rung up the ladder. Target, then Walmart, then Dollar General, then the pawn counter. It's a staircase, and a lot of people are quietly walking down it. All right, time to pump the brakes on myself, because if I just keep stacking scary numbers, I'm doing the very thing I can't stand, selling you panic. So let me argue the other side as honestly as I can, because the other side is real. Start with the pawn boom itself. It isn't pure desperation, and I'd be lying if I said it was. A big piece of it is gold. Gold has been near record highs, and gold is what most pawn loans are secured against. So when the metal climbs, the same bracelet backs a bigger loan, scrap revenue jumps, and the whole industry's numbers inflate without a single extra person being in trouble. S-Corp's scrap revenue alone jumped 64%, much of that just from gold being worth more. So part of that impressive stock chart is a gold story, not a misery story. Be skeptical of anyone who frames pawn revenue as pure pain. The same caution applies to the broader market. The S&P 500 is really a handful of giant tech. Companies earning money worldwide from products that have almost nothing to do with whether Jacob makes rent. A record index and a stressed median household aren't necessarily a contradiction. They're two different things we lazily talk about as one. And it's worth remembering that bears have predicted dozens of recessions that never came. Someone loudly calls the top of this market every year. And the market keeps responding by going higher and personally embarrassing them. The Fed isn't forecasting a downturn. The job market, for all its cracks, keeps adding jobs. So the honest version of this story isn't a crash is coming. It's that the floor is a lot thinner than the chart suggests, and that thinness is the entire point. Here's the asymmetry. When the savings rate is healthy and people have a buffer, the economy can absorb a shock, a layoff, an energy spike, and bend without breaking. But when the savings rate is at 3.6%, when subprime borrowers are already past 2008 levels, when people are already raiding retirement accounts and pawning their tools just to make a normal month work, there's no buffer left. The system is running with no slack. And remember that welded shut fire escape, the Fed that can't cut. A system with no slack and no backstop doesn't need a major disaster to break. It just needs a slightly worse Tuesday than usual. That's what the pawn shops are seeing that the stock market isn't. The market is a forecast, a bet on next year's corporate earnings, made mostly by people whose own finances are fine. The pawn counter is a measurement, a reading of how many people, right now, today, couldn't make the math work without renting back their own possessions at 200% interest. One is an opinion about the future. The other is a fact about the present. And when they disagree this loudly, it's worth asking which one usually turns out to be wrong. So here's the honest takeaway. This isn't a crash prediction. The desperation spread can close in two directions. Main Street could heal, incomes catch up, the savings rate climbs, and the gap closes from bottom. Or the market could remember it's standing on a foundation of consumers who are tapped out, and the gap closes from the top. Nobody can reliably predict which or when, but you don't need to forecast the weather to notice that an awful lot of people have stopped wearing coats. Which brings us back to Jacob and that snap-on set sitting behind the glass. Whether he ever walks back in to reclaim, it comes down to one thing. Whether next month is a little better or a little worse than this one. That's the entire margin he's living on. And there are millions of people just like him, people with jobs, degrees, retirement accounts, living so close to the edge that whether they keep the tools they need to earn a living depends on whether one ordinary month tips slightly sideways. That's not a crisis that makes front-page headlines. It's quieter than that. It's a guy in Detroit doing everything right, just hoping for an unremarkable month. Before you go, here's what to actually watch, so you're reading the signal instead of doom scrolling. If the savings rate climbs back above 5 to 6% and subprime delinquencies start cooling, that's the gap closing the good way, a real green light. But if the savings rate slips below 3% and pawn shops start reporting falling redemption rates, people unable to buy back their own belongings, pay attention. That's the day the canary stops singing. Until then, keep your own buffer healthy, keep your fixed costs lean, and don't confuse a record-high market with a healthy one. They are not the same thing. I'm Kim. Thanks for watching, and I'll see you in the next one.